Global cross-border payments operate entirely on sequential messaging. A transfer from a local bank to an overseas supplier requires data packets to bounce through a chain of intermediary correspondent banks before the funds actually settle. Because these intermediaries operate across misaligned time zones and limited banking hours, a standard international fiat transfer takes up to 2 days to finalize. To lubricate this friction, banks must park massive reserves of idle cash in accounts around the world. They freeze their own capital simply to guarantee these delayed transactions will eventually clear. This diagram illustrates the proposed architectural upgrade. On the top, we see the standard sequential chain with its requisite liquidity buffers. On the bottom, a distributed ledger executes an atomic settlement. Notice how the unified ledger handles the transaction. Payment and settlement assets are exchanged simultaneously through a smart contract. The transfer is irrevocable the exact second it executes, collapsing a 2-day delay into milliseconds. Tokenization has matured past the experimental phase. Central banks and commercial institutions are now deploying hard operational infrastructure to move their settlement processes onto distributed ledgers. This technological shift is fracturing global payment rails along geopolitical lines. Western institutions are upgrading their legacy networks, while emerging economic blocs are engineering explicit bypasses. The mechanical friction of trapped liquidity is no longer a localized back-office issue. The architecture of settlement is the new arena for international financial control. To defend the traditional correspondent model, the Bank for International Settlements is coordinating Project Agora. The institutional backing for this project commands the vast majority of global liquidity. The consortium includes the Federal Reserve Bank of New York, alongside the central banks of Europe, Japan, and Mexico. Agora aims to build a single interoperable network specifically for interbank settlements. By focusing strictly on the wholesale domain, the project avoids the political resistance surrounding retail consumer digital currencies. This architectural blueprint reveals Agora's core mechanism. It integrates tokenized commercial bank deposits by layering them securely over a base of tokenized wholesale central bank money. Operating directly on central bank reserves provides a perfectly safe settlement anchor. It strips out counterparty risk, allowing commercial banks to trust the programmable ledger. This specific integration enables highly complex operations, like conditional payments and synchronized foreign exchange trades, to clear without manual back-office reconciliation. Steady, explanatory tone. Crucially, the Agora architecture preserves the two-tier banking system. Commercial banks retain their direct deposits and client relationships. It also attacks compliance delays. Instead of repeating identical anti-money laundering and sanctions checks at every node in the chain, Agora tests shared validation processes that approve the transaction up front. Over 40 private sector financial institutions are currently building and testing prototypes for this specific settlement model. Agora is a highly coordinated defensive maneuver. It optimizes the existing system to ensure the US dollar and the euro remain the most efficient settlement assets for institutional liquidity. While Western powers are busy building their prototypes, alternative wholesale networks operating in the East are already completely live. Project mBridge launched originally under the BIS, but the organization withdrew in late 2024. China has since assumed effective control of the architecture, coordinating with central banks in Thailand, Saudi Arabia, and the UAE. This dashboard tracks the performance of mBridge over its initial testing window. The platform successfully processed over 4,000 cross-border transactions, clearing a cumulative volume of $55.49 billion. Look at the currency distribution underlying those transfers. Over 95% of that volume was settled using China's native digital yuan. The platform is actively securing trade corridors. Nations are utilizing mBridge to settle heavy energy and commodity transactions without ever touching the SWIFT messaging network. At the same time, the BRICS Alliance is deploying its own infrastructure-focused alternative to the dollar system through initiatives like BRICS Pay and the unit. This chart breaks down the proposed accounting mechanism for the BRICS unit. It bypasses fiat exclusivity by utilizing a hybrid peg, 40% backed by physical gold and 60% weighted against member currencies. The engineering logic solves two problems at once. The commodity portion anchors the unit against inflation, while the fiat basket ensures sufficient liquidity to handle massive commercial trade volumes. By tying physical bullion directly into the architecture, Member nations collateralize their own trade settlements outside of Western financial oversight. Because the settlement layer runs on distributed nodes, it operates 24 hours a day. It eliminates the latency caused by misaligned banking hours in New York or London. More importantly, it insulates participants. Transactions executed on this chain carry zero exposure to Federal Reserve interest rate hikes or U.S. Treasury sanctions. These parallel ledgers offer emerging economies direct bilateral settlement. By providing a highly efficient, mathematically stable alternative, they incrementally erode the monopoly of the dollar. Facing competition from alternative state networks and private stablecoins, the European Central Bank is aggressively defending its monetary sovereignty. This flowchart outlines the ECB's response. They are executing a dual-track strategy, dividing development into consumer retail functionality and interbank wholesale settlement. On the retail side, the ECB initiates a 12-month technical pilot in the second half of 2027, laying the groundwork to potentially issue a public digital euro by 2029. The pilot focuses heavily on mechanical viability. It tests how the currency functions during offline transactions and how seamlessly it integrates into physical point-of-sale hardware. But retail adoption is only half the equation. The ECB must ensure central bank money remains the ultimate settlement anchor for digitized capital markets. Under the wholesale track, the ECB introduces Project Pontus. This acts as a bridge, linking external distributed ledger platforms directly into the existing target settlement system. Pontus guarantees that when financial institutions trade tokenized assets, they can still settle those trades safely using central bank reserves. The immediate subsequent step for the ECB is Project Appia. Appia moves beyond bridging systems and tests the native issuance of central bank money directly onto the blockchain. By placing central bank money natively on the ledger, Appia enables fully programmable wholesale transactions without relying on private stablecoins or foreign payment rails. Through this dual-track engineering, Europe is securing its own sovereign digital infrastructure. The objective is to ensure the euro remains the absolute settlement layer within its own borders. While central banks map out pilot programs, the private sector is already moving. Commercial banks are not waiting for sovereign digital currencies to clear legislative hurdles. Instead of viewing stablecoins as a competitive threat, legacy institutions are co-opting them as high-speed internal settlement currencies. This block diagram shows traditional infrastructure evolving. Legacy core banking processors now open direct API connections to regulated stablecoin networks. Major providers like Jack Henry partner with platforms like Anchorage Digital, allowing community banks to plug directly into these ledgers. This API integration means a local bank can execute a cross-border payout in seconds, entirely avoiding the delays and margin cuts taken by multi-layer correspondent chains. Traditional correspondent networks are not going obsolete overnight. Their massive liquidity depth remains required to clear high-value commercial capital flows. To survive alongside these faster rails, legacy banking must modernize through strict automation and the adoption of rich data standards like ISO 2022. The mechanical shift is undeniable. Asynchronous, message-based payment systems are giving way to synchronous, state-based ledgers. Tokenization is the new baseline requirement for managing capital. Financial institutions that fail to upgrade their infrastructure to support atomic settlement will inevitably find themselves priced out of